Good evening. Welcome to the session. Week 4, and we're going to be looking at the accounting equation and double entry system. Good learning outcomes for this lesson. We're going to looking at analyzing transactions under the accounting equation. We're going to define assets, non-current assets, and current assets. We're going to define liabilities, non-current liabilities and current liabilities. Look at income and expenses and the rules of double entry. Okay, so just to remember the rules that we've covered before, just to recap on that. Okay, first of all, when we say we debit an account, a debit is if we have a T account. Okay, so there's a T account, something like that. And then we debit it to the left, and we credit it on the right. Okay, so when we say an asset account, when we debit the asset account, it comes in on the left. It means we are increasing the asset. Okay, for example, your bank account is an asset. So if we debit the bank account, it increases the amount in your bank. If we credit it, it reduces the amount in your bank. Okay, so those are for assets. Liabilities, that's things that you owe, that you have to pay for other people, money that you owe. In that case, it's the other way around. If we debit a liability, reduce it. And if we credit a liability, we increase the amount. Income, same as a liability. If we credit the income account, it means we increase the amount. And if we debit the income account, we reduce the amount. Okay, so if your sales, you credit your sales by 1,000 Rand, it means your total sales is 1,000 Rand. If we debit it by 100 Rand, it's 1,000 less 100 Rand, and that reduces it to 900. Expenses, same as assets, we debit an expense, then the amount increases, and we credit the expense, the amount decreases. A capital account, that is the money that the shareholders put into the business. If we debit the account, we reduce it, and if we credit the account, we increase the amount. Drawings, that's the money or goods that the owners, shareholders take out of the business. If we debit that account, we increase the amount, and if we credit the account, we decrease the amount. Okay, so those are the rules of double entry accounting. Okay, just to recap again on the accounting cycle. The accounting cycle starts when a transaction takes place. Okay, transaction takes place. We buy stock from a supplier. We get a source document that summarizes the transaction. In this case, it will be a supplier invoice. We do a journal. The journal is simply saying which account we must debit and which account we must credit and by which amounts. Okay. Then once we've done the journals, we record it in our general ledger. So the general ledger is a book that has all the different accounts in there, and each account on its own, and all the transactions will be recorded in there. And then once we come to the end of a financial period, we'll do a trial balance. And a trial balance is we will take all the debit amounts and we will take all the credit amounts and we'll add them together, and all the debits must be equal to all the credits. Okay. So at the end of the period, we then take the trial balance and we do closing entries, and we will then compile our financial statements, the statement of comprehensive income, and statement of financial performance. And that is our accounting cycle. And then we start again the next period. Okay, look at account definitions. We debit, that's the left-hand side, as I've said earlier, and the credit is the right-hand side. We're going to look at some of the definitions. Okay, let's have a look at assets. The assets are economic resources controlled by the business, resulting from past events from which future economic benefits will flow. So what we mean by that, let's assume I'm going to be buying a delivery truck for my business. So I bought a truck a week ago, and that truck is then an economic resource. I'm going to do something with that truck. So I control the truck. In other words, I have possession of the truck. I must pay the insurance. I must look after it. I must pay the licenses, and I must keep it secure. And I must put the petrol in. So I'm in control of that truck. Okay. So yes, that's the first one. It's a resource that I control. The second thing is from past event. Yes, I purchased it a week ago. So the truck was purchased a week ago. From which future economic benefits will flow. I'm going to use this truck to deliver goods to my customers, and I'm going to charge them for that. So that will then mean that, yes, a truck will then satisfy the definition of an asset. We then classify the assets into the two categories, non-current assets and current assets. And the difference between the two, non-current assets are items with a lifespan of more than 1 year. So a truck lasts for more than 1 year, for 5 years or 10 years, depending on how you treat it. So the typical things that you will have: property, plant, and equipment. Any properties you have, your machinery, your equipment, your vehicles, your computer equipment, all those are items with a lifespan of longer than 1 year, and therefore will be non-current assets. Then we have financial assets such as investments. If you hold shares in another company, that's an investment. If you have a fixed deposit at the bank, that's also a financial asset. So those are all longer than 1 year, so that's also non-current assets. Then we have intangible assets such as patents. Now, patent rights, if you designed a particular product and you registered the patent on it, people must pay you every time someone makes a product like that and sells it. They have to pay you royalties. So that patent that you have, we show as on your balance sheet as an asset as well, and as a non-current asset. Then we have current assets. Those are assets with a lifespan of less than 1 year. Okay, so if we look there, we will have cash. That's money in your bank. Now we all know when you get your salary end of the month, that cash comes into your bank one day and it's gone the next day. So yes, the lifespan of cash is very, very short, definitely less than 1 year. Debtors, those are clients that customers that you sold products or services to, that will have to pay you normally within 30 days or 60 days, depending on that. If you think of a media company, let's say you have a newspaper, you will have people that get the newspaper every day, but they pay their account at the end of the month. So those will be debtors as well. Okay. Stock, that's the stock or inventory. That's items you use for resale. Okay, so if you're a magazine company and you sell your magazine, you print it every week and you sell it, that stock of magazines will be a current asset. Okay, so those are your assets. Then we go to our liabilities. Again, the definition of a liability, it's a present obligation resulting from a past event, the settlement of which leads to a decrease in economic benefit. Okay, so let's assume that truck that I bought a week ago, and I bought it for R1 million, and I got a loan from the bank. I did a installment sale agreement with the bank. So that R1 million that I owe the bank would be a liability. Let's have a look. Why? It's an obligation. I have the obligation to repay that R1 million to the bank. The past event, when I purchased the vehicle, I got the loan from them. And the settlement, which leads to decrease in economic benefits. As I pay my installment on the car, I have less money in my bank, and that reduces my economic benefits. Okay, so again, we can split the liabilities in terms of non-current liabilities and current liabilities. So non-current liabilities, these are obligations payable over more than 1 year. So long-term loans, like the one for the truck that I bought, it's a long-term loan, will be a non-current liability. A bond over my property is also a non-current liability. Then we have current liabilities. These are liabilities payable within 1 year. So if you have a bank overdraft on your check account or your current account, you sometimes go the other way and you owe the bank money. So that's called an overdraft. And that would be a current liability. And also creditors is an example of a current liability. Those are people, suppliers that you bought from, that you owe money to, and then you must pay them. So those will be your creditors. And then let's have a look at your accounting definition. Your profits, it's your income minus expenses. So if you take all your income and you minus all your expenses, that will be your profits. Okay, the way that we do it in accounting is we take our sales less our cost of sales. So on our income statement, we can start with sales, less cost of sales, and that will give us our gross profits. Yeah. And then if we take our gross profit and we subtract our other expenses, that will give us our net profits. Okay, so if we go to our textbook, and we're going to look at activity 3A, page 39. So I have no one with me, so I'll talk you through it so that, but it's maybe you can just, if you're listening to the recording, is to look at the activity, stop and try it, and then listen to my explanation. Okay, so activity 3A, let's read it. The owner of Panda Motors has decided to buy 5 vehicles, 4 of which are for resale purposes. Remember, it's Panda Motors, they're a motor car dealership. So 4 of them he's going to sell again. And the 5th vehicle will use to deliver spare parts to customers. So do you think the bookkeeper, is the question is, do you think the bookkeeper of Panda Motors should treat the 5th vehicle differently to the other 4? Give your reasons for your answer. Okay, so let's see it. Let's look at the definition of an asset. Okay, there are vehicles, yes. So these are resources, I control them. From a past event, yes. And they're going to lead to future economic benefits. However, the 4 vehicles I'm going to resell is going to lead to economic benefit much quicker. So that will be within 1 year. Okay. And the delivery vehicle is also going to deliver economic benefits, but that's going to be over a long period of time. So yes, they're all assets, but the vehicles that we're going to resell, the 4 will be stock or inventory, and the other one will be regarded as a non-current asset that will stay on my books for the lifespan of the asset. Okay, then activity 3B on page 39. Okay. Then they give, so from the list below, identify the items that will be regarded as assets. Explain why these items should be regarded as assets and why the others should not be regarded as assets by the bookkeeper. Sorry. Okay, so let's look at the first one. It's office equipment. Okay, so office equipment is an asset. It will last longer than 1 year, so it'll be a non-current asset. Advertising costs, those are expenses that you incur to advertise your business. Expense is, it's not, you are not acquiring an asset that you will keep, so it's simply an expense. Traffic fines, these are also expenses. Favorable bank balance, because that means you've got money in your bank. The money in your bank is an asset, and it's a current asset. Trading inventory, like we've talked about the 4 vehicles that you have, those are current assets, okay, and which you're going to resell again. So it's resource control, and will bring economic benefits. A fixed deposit, again, it's a non-current asset, money that you invest in the bank for a long period, and you're going to be earning interest on that. So that's the economic benefit that will flow from that. Vehicles, non-current asset. You're going to keep it. It's an asset. It lasts for more than 1 year, and you will use it to generate income. Then we've got packing materials. Okay, packing materials, I was just explain is if you sell a product and you have to put it in a box, okay, that is, the box will be packing material, and that is treated as an expense, okay. But then when you do further accounting, when we start with adjustments, when a year end happens and you have a lot of packing material left over, then we're going to reclassify them as a current asset. So although in this case we will show it as an expense, under certain circumstances you will then reclassify it as a current asset. Fuel, that's your petrol, diesel you put in your vehicles. That's simply an expense. Okay. Office consumables, again, that is stuff that you use in your business, and those will be expenses. And then the rest of activity 3B is to briefly explain the accounting cycle, which we have just done. So just make sure that you understand that. Okay, let's have a look at activity 3C on page 41. Okay, there's some the activity says on January 2007, Peter Makonza bought a vehicle on hire purchase for 260,000 Rand. This is not the cash price, but the hire purchase price. This means that the interest for the whole financing period has been added to the cash price to arrive at 260,000. Okay, so he obtained a loan, which he must repay in total, the loan plus the interest of 260,000 Rand. His vehicle is fully financed through Best Finance CC. The terms are 20,000 Rand deposit and repayments of 2,000 Rand per month for a period of 10 years. Starting with the first premium on 31 January 2007. Assume that Peter is sole trader and that his business financial year runs from 1 January to 31 December. Okay, so now you've been asked to classify the business liabilities into the current liabilities and non-current liabilities as at 31 December 2007. Okay. Assume that all the premiums due to Best Finance CC for the year have been paid by 31 December, including premium due on 31 December. Okay, so what we'll have to do is we have to now calculate. He borrowed 260,000, which he now has to repay. He pays 2,000 Rand a month. So 2 times 12. So he's repaid 24,000. Okay, so he's now paid the deposit of 20,000 plus the 24,000. Okay. So he still owes 240,000. And now he's paid in 1 year, he's paid 12 times 2,024. So if you take the 240,000 and you subtract the 24,000 is already paid, he still owes 216,000. Okay, 240 less 24 is 216,000. Okay, but of that 260,000, he's got to pay the next year. Remember, with the end of the year now, we want to have the balances for the next year. So the next year he's going to pay again 12 times 2 is 24,000. So we will take that and we classify that as a current liability. And we call it a short-term portion of long-term borrowing. Okay, 24,000. And if you take the 216 less the 24,000, you're still left with 192,000. And that is going to be your non-current liability, which you still owe. So what you do is you take whatever is owed, you've got to work what is the current portion for the next year, and you call it your short-term portion of long-term loans, and that's a current liability, and the balance stays as a long-term liability. Okay, so that is activity 3C. Oh, activity 3D that we have on page 42. They have given us a list of assets and liabilities on the books. And they want you to calculate the total for non-current assets, total current assets, total of non-current liabilities, total of current liabilities, and the owner's wealth, the equity. We'll have to come back to the owner's equity. Okay, so let's have a look. So if you go to that page 42, I'm going to take each of the items and I'll just explain what they are in the sense whether it's current asset, current liabilities, etc. So we've got equipment. Equipment will be a non-current asset. Debtors control. Debtors are the people that owe you money. So that's a current asset. Petty cash. Petty cash is the cash that you keep on your premises to buy bread and milk and things like that. So it's cash. So that's also a current asset. Bank, unfavorable. What they mean by unfavorable is that you owe the money to the bank. So you're in overdraft. So that is a current liability. Then we've got vehicles. Vehicles is a non-current asset. Creditors control, that's money that you owe to your suppliers. So that's a current liability. Land and buildings, that is a non-current asset. Mortgage loan, that's a long-term loan that you have on your buildings. That will be a non-current liability. Cash floats. Okay, I had the question in class today, cash floats. If you go to a Pick n Pay or a Spar and you get the person at the till, when they open the till, they put a lot of cash into the till so that they have change when you buy. Okay, and that is called a cash float. So that's a current asset. Trading inventory, that's stock that you're going to trade. So that's also a current asset. Okay, now the loan from Plewman's Bank of 124,000. Okay, so remember from the previous activity, we had to split it into short-term portion and the long-term portion. So 24,000 of that amount will be a current liability, because that's a 24,000 redeemable by 28 February 2008. 24,000 current liability, and the balance of 100,000 is your long-term liability. Okay, so that is the activity 3D. So once you've classified them, then you simply add them up to get your answer. The answers are on the back of the book, so you can check whether your answer is correct. Okay, so now we're going to go over to what is called the accounting equation. If we look at the accounting equation, it says assets is equal to owner's equity plus liabilities. Okay. Whenever you take your accounts and you classify them as assets, owner's equity and liabilities, this accounting equation will balance or should balance. Okay. Okay, if you simply do the arithmetic, you can then say owner's equity is equal to assets minus liabilities, or liabilities are equal to assets minus owner's equity. But the basic accounting equation says assets is equal to owner's equity plus liabilities. Okay, the right side of the equation, in other words, the equity plus liabilities, that shows where the money is coming from for the business. Okay, to purchase the assets, which is on the left-hand side. So the equity and liabilities is where the sources of money. to acquire the assets on the left-hand side. Because the equation must always balance. Whenever you do a transaction, the equation must still balance. Every transaction you do affect the elements, in other words, the assets, equity, and liability, and then the accounts within the elements. We will still be doing some exercises on that. Okay, if we know the equation, assets is equal to owner's equity plus liabilities, we must be able to balance for an unknown element. For example, if you are given the following, we have assets of 750,000 and owner's equity of 250,000. What is the value of liabilities? Okay, so remember we said assets is equal to owner's equity plus liabilities. It's also written like this. I'm going to try and write it like that. Assets is equal to owner's equity plus liabilities. Okay, so that is the equation. So we take our 750,000 assets, we put it there, is equal to equity, owner's equity, 250 plus liabilities. So when we do the maths, we will say liabilities is equal to 750,000 minus 250,000, and therefore liability is equal to 500,000. So you must be able to do a calculation either way. If you get two of the variables, you must be able to calculate the third one. Okay, so that was for an unknown element. Now for an unknown account value. Okay, so if we take this information, we want to know what our bank balance is. Okay, so, and they've given us the following account balances. So the way to attempt this is we're going to classify each of these in terms of the accounting equation. Okay, so vehicles, I'm going to try and do it. That's an asset. Debtors is an asset. Mortgage bond is a liability. Fix that a bit. Liability. Capital, owner's equity. Loan is a liability. Inventory is an asset. And creditors is a liability. So once we've added, we have now classified them in terms of where they belong. Now we can do the following. So we know assets is equal to owner's equity plus liabilities. So we know that we've got assets, we've got the bank, we've got the vehicles, got debtors and our inventory. And the owner's equity, we've got capital. And under liabilities, we've got the mortgage bond, the loan, and the creditors. Okay. So now we'll do the maths. So the bank is the plus vehicles, 150,000, plus debtors of 50,000, plus stock of 25,000. That must be equal to capital of 120,000 plus the bond of 110,000 plus the loan of 80,000 plus the creditors of 50,000. So if we redo the calculation, we say the bank plus 225,000, that's just those three amounts together, is equal to 360,000, which is the 120 plus the 110 plus the 80 plus the 15. And then it's bank is equal to 360 minus 225, and that gives us our balance of the bank is 135,000. Okay, so the previous page, we looked at how to find out an unknown element. So we must be able to calculate assets or owners, equity or liabilities. And in this example, we must be able to find any unknown amounts for an account. Okay, so that's for tonight. Next week we will continue with doing transactions and show you a bit more about the T accounts that we work with. Okay, thank you very much and goodbye.